Okay, this is the second video on chapter 14, and I'm starting where we stopped last time, namely at paragraph 14.2.3. I think it's quite important to read the taxation of small and medium-sized enterprises. The first thing is to know what the cash flow tax base is equal to. It's just what it says. So all the revenue, all the receipts that you get from sales, whether you borrow money or whether you receive interest, that's all your receipts, and then you just subtract all the expenses, namely purchases, interest payments and debt repayments, and that is the base on which you will be taxed. Very, very easy, very simple, isn't it? So what are the advantages? It's simple and it's neutral with respect to the use of capital. You don't have to worry about all the shortcomings. So I don't want you to memorize everything about a specific tax as if this was an accounting course. But we are interested in administrative efficiency, so if something is simple, then we're interested in that from that point of view. So you also need to know what is a turnover-based presumptive tax. So I'll talk about presumptive taxes just now. So a cash flow tax versus a turnover-based tax. So businesses with a turnover of less than 1 million rand per year could choose to have the option of this form of a tax. So in table 14.1 they have the income tax on cash flow, and then they have at 14.2 the rates for a turnover tax. So a company can choose between the two. Now you obviously don't have to know the tax rates and the tax brackets and so on. But what you do need to know is what is a presumptive tax. So why is the turnover tax a presumptive tax? So I found a nice reference in the literature on presumptive taxes. A presumptive taxation involves the use of indirect means to ascertain the tax liability. So what does that mean? So then this author has another quote from another source which is really clear. The term presumptive taxation covers a number of procedures under which the desired base for taxation is not itself measured, but is inferred from some simple indicators which are more easily measured than the base itself. So we want to tax income and we want to tax profits. But for a small company, it's much more difficult for SARS to determine whether they have calculated their profits correctly, or even for themselves to calculate the profits and the tax liability. So it's really very easy to say, let's just take the turnover and have a rate of tax on the turnover, because the higher the turnover, the higher the income and the higher the profit should be. But they have a choice, so they can either do the regular way of calculating income to be taxed, or they can use an indirect means to estimate what the profits or income would be. And in this case, the instrument is the turnover. So then we get to what we want to be at for each tax, each type of tax, namely the elements of a good tax. Now, how efficient is a company tax? There's a small paragraph about that which you should read very carefully and be able to give back in an essay type question. 14.3.2 continues with efficiency, because the decision to invest, you don't need to read all of this. I think the only thing is know what the marginal effective tax rate is. They'll leave a definition of it. So what is the effective tax rate that you pay on an investment? Why is that important? It's important because if the tax rate encourages investors or discourages investors, that means it influences their decision making. It influences their behavior. And that's why it's important from an efficiency point of view that the tax rate should be such that behavior doesn't change significantly. What is really important is 14.3, not important, interesting, 14.322 non-tax factors. And why do they have that? Because they say, and I think as an economist and as a public finance knowledgeable person, as a 310 student, you should know why do they have this in. And they say, well, the effect of taxes is minor compared to the impact of other factors. So we learn, and someone in class asked me, why do we need to learn all about these taxes? And that person was to some extent correct, because what they say here is that the effect of taxes is really not so big. There are other factors that are really important, and I think we in South Africa know exactly what they mean by that. An investor would rather look at the business opportunity, the opportunity to make profits, than the marginal effective tax rate. How politically stable and how is the government run is important. So if a foreign investor has to come to South Africa and they think about political stability and good governance, what would they think? And would they really think about the small differences in tax rates, or would they see this as a huge elephant in the room? Economic stability is important, labor stability. We have 35% unemployment rate, and sometimes we have strikes and so on. So that's the type of things that investors will think of rather than tax rates. Property rights. What will happen if the government can grab land? I mean, there's a huge debate about property rights on land currently going on, and I think that could scare investors off much more than a small difference in the tax rate, etc. So yes, the non-market factors are very, very important. Then we get to the next paragraph, tax incentives, 14.323. You only have to read the first paragraph. What is a tax incentive? They give lots of examples. You don't have to do the reasons for and against tax incentives for this course. But I think it's good to just have an idea of what we do in South Africa. So we do have lots of tax incentives for investment in South Africa by the Department of Trade and Industry. There are many examples for you. Are they good or are they bad? So you should be able to criticize the fact that DTI provides tax incentives. Does that have to do with fairness or efficiency or administrative efficiency or flexibility? What does it have to do with? And that's a question that you need to be able to answer. Then we get to fairness itself. It's an easy read, so important. How fair is a corporate income tax? And then we get to capital gains tax. Well, what is a capital gain? It's just an increase in the net value of assets over a period of time. So some countries would have an accrual system where whether you sell the asset or not, if it increases in value, you may be able to pay tax on that. Fortunately, we don't have that. We have the system where as soon as you get rid of an asset, then you have to report on the increase in the value of the asset, and you pay a capital gains tax on that. So it's only when ownership is changed. Even if you give something away, that's interesting, isn't it? So if you receive a gift of shares from your uncle, then capital gains tax is still to be paid on the increase in the value of the shares since he bought them until he gave it to you. So the gains from these assets form part of your income tax base, and then it's taxed at the rate at your marginal tax rate. The reasons for a capital gains tax is important. You have to read through this carefully. The integrity of the personal and corporate income tax base. What does that mean? It means that if capital gains are not taxed, then people can hide income in the form of capital and they never pay tax on that. Then two equity principles, horizontal and vertical equity, and also an efficiency reason, because it's more efficient to have the tax than not to have the tax. Then the arguments against capital taxation. It's difficult to administer the tax. It's difficult to calculate the values of certain assets. For example, if you have a piece of art, what is the value? What was the value when you got it? And I mean, in real terms, it's really difficult to value things. So the administrative problems are difficult, and usually capital gains is on the nominal increase in an asset, which is perhaps unfair if you sell your house. If I sell my house now, when I bought it, it was only a few thousand rands, and now it's hundreds of thousands just because of inflation. So if only nominal profits are taxed, then it's really unfair to have the capital gains. And the third reason is we don't sell assets every year. So let's say once in 10 years you sell a big asset, and then suddenly you go into a much higher tax bracket. The next year you don't have any assets to sell, and then you're back to your previous tax bracket. They don't smooth this off over time, and that is also a bit unfair. Okay, the good news with regard to income tax reform is that of paragraph 14.5, you only need to read the first paragraph. What is income tax reform and why do we have reform? But the detail of the proposed reforms you don't have to do, and that's the end of the second video and the end of the chapter.